All right, welcome to topic 6. So today, again, it's week 7, so I don't expect a large class. People are studying for midterms, that's fine. Today what we're going to be doing is going over cost of capital. Again, cost of capital, you would have covered it in some other classes. So you probably would have covered it in like fundamentals of finance, maybe even some of your accounting classes. Some of you are, I think Kim is doing corporate finance, for example. So you would have covered this concept in many other areas. This week, again, we're just doing it for the purposes of valuation, but we're also going to be doing it a slightly more practical approach than you might have done in the past. So in the past, so if you've done, for example, your fundamentals of finance class, you might have been asked to calculate the cost of equity, for example. And you might have been given like, this is the beta, this is the risk-free rate, this is the market premium, please calculate the cost of equity. So you basically just have to plug and play in terms of a formula, take those inputs in, put it into a formula, and get some form of cost of equity. So this class, what we're doing particularly is just trying to understand how do we get those inputs and what are the various ways of getting those inputs. So for example, if we're looking at beta, how do we estimate beta? What are the options that we have when we estimate beta? What are the pros and cons of each option? And what you'll see, I guess, in this class is really that when it comes to cost of capital, this is probably the most probably controversial part of evaluation in the sense that most of the inputs are very much up for debate. In the sense that how you calculate beta is up for debate, how you calculate the market premium is up for debate, and so forth. Seems like this one is not working. So when we're estimating the cost of capital, effectively what we need to do is to get some form of a discount rate for all valuation models. So again, when we come to next week, when we need to, for example, estimate the discounted cash flow model, we need to have a discount rate, because if you remember, you have some cash flows at the top of the equation, and then we discount it by some discount rate. And this week is all about estimating that discount rate, and in practice what we use is the weighted average cost of capital. Again, this formula you would have probably seen in some other classes in the sense we figure out what is the cost of our equity financing, what is the cost of our debt financing, figure out the proportion of each one to figure out what the weighted average cost of capital is. Again, not really that hard, it's a pretty straightforward formula. In terms of this week, what we're essentially doing is figuring out how do we estimate each and every part of this equation. That's essentially what we're doing. Again, this formula is a bit boring, so for your project, what you can instead do is to try to visualize it. So if you remember in week 1, I provided you with an example of a fairness opinion for a Swiss firm, so it's Syngenta. In their fairness opinion from this particular firm, they made a nice little graphical representation of their weighted average cost of capital. So they essentially broken it down to the cost of equity, cost of debt, and then for the cost of equity, what risk-free rate, what pre-levered beta, and what market risk premium did they use. We also have the proportion of the equity, the proportion of the debt. So it's a really nice way to visualize quite a long quite a lot of information. And here on the left-hand side, what they've done is essentially justify each and every input. So for your project, what you essentially need to do is more or less figure out exactly everything on this screen here, and again, justify each part. And again, like I said, most things here are up for debate. So if you're looking at the actual inputs here, so it's the risk-free rate, the pre-levered beta, and the market risk premium. All three are up for debate in terms of how you estimate them and what value you'll actually get. And what you'll see is depending on which method you choose, you're going to get a vastly different number. So all of those things actually have quite a dramatic impact later on the valuation. So again, for this week, essentially what we're doing is figuring out how do we estimate each and every part of the kind of weighted average cost of capital. Again, when we go through this, what you'll see is that some parts are easier than others. So the cost of debt part, still up for debate, but not as much. Cost of equity, very much in the sense that it's very easy to have many different options when it comes to the cost of equity. So what we're going to do is we're going to start with the cost of debt because that's generally slightly more straightforward. Again, when we're looking at cost of debt, The name itself kind of implies what we're looking at. We're effectively just trying to figure out how much does it cost for a firm to borrow money in terms of debt. So if they want to get additional debt funding, how much is it going to cost them? And it seems a bit straightforward in the sense that, okay, so can't we just look at what they're paying the bank? Well, that's actually one way, but you can do it many other ways as well. So essentially, debt, and what we're looking at here, is really any form of interest-bearing liability. So it's essentially a situation where you've borrowed money and you essentially made commitment to pay fixed payments into the future. These fixed payments, so interest expenses, are usually tax deductible in most jurisdictions, and if you fail to pay them, then you'll usually get some form of a penalty in the sense that some of your assets might be seized and so forth. Generally speaking, it's very easy to identify debt because you will need to do this, and what we generally look for is the interest-bearing liability that the firm has. On its balance sheet, it will usually have short-term debt and long-term debt, and you'll usually pick those out. But traditionally speaking, you could also include lease obligations because in the past, not so much in the future, companies tried to structure leases in a way that they could essentially have a debt liability but not actually recognize it as debt, but instead to try to show it as a lease. Because of the new leasing standard that's, I guess, coming up, firms are essentially not allowed to do this anymore, so this is going to be much less of an issue. So essentially, debt is, again, any form of interest-bearing liability. That's kind of the shortcut. So the definition is not necessarily the problem here. When, I guess, we're trying to figure out how much is the cost of debt, so what is the percentage rate? That's where you start to have a number of different options. And again, cost of debt is not necessarily too controversial, but you still have a few different options. So again, the easiest way in terms of, I guess, if you're thinking about rational way, most people might say, I'm just going to look at the firm's interest expense and compare it to its financial debt. And by dividing the interest expense by the financial debt, essentially figure out how much are they paying in a percentage term. Nothing wrong with that, but it's not going to give you the most accurate picture. So when we do evaluation, do we do it for the next year, for the next 2 years, 3 years, 4 years, 5 years, 100 years? What do we do? 5. Why 5? Seems familiar. That's good. It's a good try.
It depends on like what the reason for the evaluation.
Awesome. Yes, it kind of depends. So generally speaking, it depends on the purpose of your valuation. If you're just valuing the firm from the perspective that we're going to buy and hold this stock for the next 5 years, well, you can do look for the, I guess, the next 5-year period. But if you're going to value the firm for an eternity, so essentially forever you want to buy and hold it and basically don't have any plans to sell it, you need to make sure that your cost of debt is long-term. What you're paying in interest expenses right now might be reflective of the past, but it's not necessarily going to be reflective of the future. So for example, if we're going to look at European firms right now, some firms in Europe have effectively a cost of debt of less than 1% right now because interest rates are super low. But they're not going to be super low into the future, which means that the current interest expenses might not be the most appropriate thing to use. So again, when we estimate cost of debt, we have a few different options. If you're dealing with a large firm that issues corporate bonds, and again, this is generally for very large firms in particular markets such as the US, usually they will have a credit rating. So for example, if I go to Bloomberg, let's see, if I go to Bloomberg and I type in Time Warner, so TWX, US equity, select that firm, you have an option here saying credit rating profile for the, or the function is called CRPR. So if you click there, you'll get an overview of the credit rating for Time Warner. So this will tell you what the credit rating agencies feel Time Warner is in terms of, its overall risk. So you can see that, for example, Moody's believes that the long-term rating is Baa2. Standard & Poor's, again, long-term foreign issuer credit is BBB, and so on. So essentially what we have here is an overview of different rating agencies and how they feel in terms of Time Warner when it comes to its risk. what you can do is effectively use these ratings and combine it with an appropriate risk-free rate. So you take the risk-free rate, which is essentially what you would expect to get as a return without actually accepting any form of risk. So essentially it's a sure thing. And then you know that by giving credit to Time Warner, you're accepting some form of risk. You're taking that credit rating to figure out what is an appropriate amount of additional return that I need to get to accept this risk. So essentially, if you're using the firm that is rated, you can essentially figure out what is the appropriate default spread based on that rating. So default spread is essentially the premium you get above in addition to the risk-free rate. So that's one way. The second way is to figure out is essentially what are the bonds currently giving out. So if the firm is actually issuing bonds, what are the yield to maturities on those bonds? So essentially trying to figure out what are they currently borrowing from the market at. So in the case of Time Warner, I think I have it here somewhere. So here's an overview, for example, of Time Warner's bonds. I think this is from last year. So you know essentially when the maturity date is, what the amount that they borrowed for each bond, and essentially what I'm looking for is really the yield to maturity. And I can see that it kind of ranges from 2.7 to about 5-ish%. So it's still quite a large spread, but it kind of gives me an overview of all the kind of issued bonds and what they're paying on them. So what I could do theoretically is either select the most recent one because it's the most relevant one, or I might try to figure out a weighted average here based on perhaps on the amounts and the percentages. So I figure out if one is basically for 30 billion, that's going to be more important for my calculation for the cost of debt than one that is for, let's say, 800 million and so forth. Again, this is one way to do it. So to basically just look at the current bonds outstanding. Now, for most firms that are not US based or not huge, you won't have bonds generally, and you might not have an official credit rating. So you might instead go through the notes of your company and figure out what is the interest rate that they're currently paying. So I said that technically this is not a great approach, but if you have no other option, this is acceptable. So again, you can usually either look at the current interest expense compared to the financial debt, or if the firm discloses it, sometimes they will actually write in the notes what is basically the weighted average effective interest rate that they're currently paying on the debt. So you go through the notes and you figure out kind of what are they currently paying to the banks and so on. And then finally, we have another one, which is essentially estimating a synthetic rating. And the synthetic rating is essentially a rating that is not done by a credit rating agency. You're just trying to estimate a synthetic one based on what you believe, based on some form of ratio. So usually it will be an interest coverage ratio. So it's a ratio that basically looks at how many times over can you pay your interest expenses using your operating income. And again, I'll show you guys an example and so on. Probably one of the key features for this week is that really when we're looking at cost of debt or cost of equity, we need to value and kind of estimate everything in the same currency. So if we're going to be valuing the firm based on US currency, then cost of debt and cost of equity needs to be in a US currency perspective. Seems weird, but sometimes you might actually have a developing country, and you have a company there, and you might actually value it in US dollars instead of local dollars. So depending on which currency you choose in terms of your cash flows, it's going to impact how you're going to be estimating cost of debt and cost of equity. So again, using an official rating, so you look up the official rating on Bloomberg or whichever service you might use. And that rating effectively tells you the riskiness of the company. Usually A's are better than B's, B's are better than C's, and so on. So here, for example, we have three different examples. We have Disney, Deutsche Bank, and Vale. Vale is a Brazilian mining firm. So if we want to figure out what is the cost of debt using a credit rating of these firms, we would look at the S&P rating, for example. For Disney, it's A. We would then look at the current risk-free rate. So it might be 2.75%. We then add a default spread. So the default spread is directly linked to the S&P rating. So the better the rating, the lower the default spread is. So A minus is less, or I guess it's worse than an A, which means that the default spread is higher. So essentially you take the risk-free rate, add the default spread, and you get the cost of debt. So again, what you essentially do is quite a simple approach here. Now again, I mentioned that you should be valuing it in the same currency in the sense that if your cash flows are in US dollars, then the cost of debt should be in US dollars as well. Sometimes you might want to convert between different currencies. So for example, if we want to estimate Vale's cost of debt in its home currency, so in Brazilian currency, we can use a differential inflation approach because really the only difference between the cost of debt between two countries is really the differences in inflation. So again, what we essentially do is we take the 1 plus the cost of debt in the US, and then we multiply it by 1 plus the expected inflation in Brazil divided by 1 plus the expected inflation in US minus 1. So essentially we just plug and play into this formula. So it allows us to account for the differences in inflation to figure out what the cost of debt should be in Brazilian currency. Again, you would usually only do this if you needed to convert things. Usually you will probably just stick to one currency. So if you're valuing a firm in Brazilian currency, you usually try to figure out what the risk-free rate is in Brazil and so forth. But if you can't, well, you can still convert things after the fact as well. Again, using the rating is probably the easiest approach, I would say. Yes?
Sorry if you already said this, I must have missed it, but where did you get the default spread from?
Usually the default spreads, easiest place to get it, actually, you can find them on Bloomberg. Easiest place to find them is on Google. So default spreads credit rating. And usually the first hit will be the most appropriate one.
Oh, so it's already established for you.
Yeah, so you don't have to figure this out. Basically what people do is they figure out, based on these currently rated firms, on a sample of like a couple of thousand, what are they currently paying to figure out what is the implied default spread. So you could use a table like this, for example, that if your rating is AAA, then the spread should be 0.6 and so forth. So again, you can just Google it. There's a few different approaches. So again, using ratings are probably the easiest way to do it. Using corporate bonds, as I mentioned, is another approach. So you could look at the current issued corporate bonds to figure out what are they currently paying. So what is the yield to maturity? What is the amounts for the debt, basically issued bonds, and also what is the maturity date? Again, there's pros and cons in the sense that this might not be reflective of the future because some of these might have been taken, I guess, might have been issued a long time ago when interest rates were much lower. So usually the first approach tends to be a bit better because it's current. Using corporate bonds might mean that you might be using corporate bonds that were issued a long time ago. Again, you can solve for this by looking at the most recent issued corporate bond. So that's one solution. But again, technically, there's nothing to say that just because you can issue a corporate bond right now at 5% interest rate does not mean you can do so forever. So that's still somewhat of a disadvantage. So you always need to consider that if you're valuing a firm for an eternity, so basically as a perpetuity, we need to have the longest term estimates that we can. So this includes the cost of debt. And again, sometimes it's just not possible, so you just need to kind of do what's probably the most appropriate and not what's kind of perfect. The other approach is synthetic ratings. So say, for example, we have a firm that is small or maybe a European firm that does not issue any corporate bonds. So they might not have a credit rating. So if your firm does not issue bonds, generally they have no need to get a credit rating. To get a credit rating, they have to go to a credit rating agency, pay them money. If your firm is small and does not issue bonds, you won't have that. So what you can do for these types of firms is to figure out what the synthetic rating is instead. So the synthetic rating is effectively trying to shortcut the ratings process. So when they do a ratings process, they look through all of your financials. They do things like bankruptcy prediction to figure out basically how solvent are you and how risky is your business. If you want to take a shortcut to this, what we can do instead is to look at one particular ratio, which is the interest coverage ratio. So the interest coverage ratio basically looks at your EBIT and divides it by the interest expenses. What this tells us is how many times over can you pay your basically commitments using your current profits. So a higher ratio, the better, because essentially you're more safe. If you have a negative number here, it effectively means that you don't have any profits and essentially that you're not really that solvent. So again, for example, if we're looking at Disney, we might look at its operating income, its interest expense, and figuring out what the interest coverage ratio is based on that. And again, you might say, well, how do I then use that interest coverage ratio? And again, that same website, the first hit on Google, first column here is if interest coverage ratio is greater than maybe 8.5, then the rating is AAA, spread is so and so. So you would use the exact same website in this case. So again, what you can do here is essentially figure out what is the interest coverage ratio and then use a table such as this, for example, to figure out what is an appropriate rating and what is an appropriate spread. Again, sometimes, for example, this table splits it up into large cap or small cap stocks, or I guess developed or emerging nations. And the idea here is that if you're a small firm, your default spread will be higher even though you have the same interest coverage ratio. So for example, if you're looking at a AAA rating, for a small firm to have a AAA rating, they need to have an interest coverage ratio of about 12.5. For a large cap, they need to have above 8.5. So there's essentially a different standard. Similarly, if you're looking at an emerging versus developing nation, again, if you're located in a developing nation, people will generally have higher expectations of you in order to get a AAA rating. So again, based on this table, we can see, for example, Disney is a large cap in a developed nation. Its interest coverage ratio is 22.57, so it's above 8.5, which means that it's a AAA. If you look at, for example, Vail, it's a large cap, but it's based in Brazil, so it's still emerging. So it's 11.76, so it fits in the second category, so AA and so forth. And the idea here is essentially that you get a synthetic credit rating for firms that are not rated. Again, this is not the most optimal way to do it because usually you will see that for firms that are actually rated, you can then start to compare what is their official rating by S&P versus what is the synthetic rating that we are estimating. And usually you'll find that there will be differences. So for example, Disney synthetic rating based on this table is AAA. Back when this was estimated, its actual rating by S&P was simply an A. So essentially there is a difference in the sense that the synthetic rating makes it seem like it's safer than it actually is. And really what we can attribute that to is the fact that when S&P or Moody's or Fitch or any credit rating agency looks at a firm, they're not just looking at one ratio, they're looking at a history of performance. They're trying to basically look at the qualitative factors and everything that you can essentially try to understand about a business. So again, we have basically a synthetic rating that just looks at one ratio. It does not really account for any kind of sector-wide biases in the sense that some industries are generally going to be seen more safe than others, even if you have a different or the same the same interest coverage ratio. And again, we're not necessarily just focused on 1 year's of performance. If we were to go to a credit rating agency, they're going to look at your past 5 to 10 years to figure out what is a normal level of earnings for you, not just what is the last year's level of EBIT. So again, when we're looking at this, it's essentially synthetic ratings. It's a shortcut process. It's not going to be as accurate, but if you have no other option, still acceptable. And again, if we're looking at, for example, Vail, well, Vail's real rating is again worse than its synthetic rating. When it comes to a country from a developing nation or in an industry that's slightly volatile, the synthetic ratings will tend to inflate the ratings. So again, Vail is in Brazil, so usually we would say that the lower rating, that's the actual rating, might be because of country risk or industry risk and so on. So again, this is the synthetic rating approach. Now, again, as I said, the cost of that part, not that hard in the sense that you still have options in terms of how you estimate things, but it's still a bit straightforward. So the second part of today is really about the cost of equity. So the cost of equity, and again, if you read the top line, in finance, the cost of equity is the return, often expressed as a rate of return. A firm theoretically pays to its equity investors to essentially compensate them for the risk they undertake by investing the capital in the firm. So essentially you're compensating them for their opportunity cost and essentially compensating them for attracting a certain level of risk by investing in your firm. Does everybody know this formula? Ooh, yes, no? Yeah, I see some nods. Cool, awesome. So basically, this formula is not new. What we're essentially trying to do here is trying to figure out how do you actually estimate this in practice for each and every one of these inputs, because for each and every one of these inputs, there are multiple different options in terms of how we would actually apply it. So for example, risk-free rates. Do you guys remember what is a risk-free rate? Awesome, paraphrasing of the terminology. I know, it's really good. It's a gift. Nick, it's a gift. It's a gift.
I'm gonna be paying attention.
Yeah, don't worry about it. All right, so the risk-free rate, what Nick said is actually completely true while he's browsing real estate. It's cool. Is essentially the rate of return you would expect if you accept no risk. The easiest way to figure it out is by looking at a government bond, and specifically a safe government bond. So if the Australian government issues a bond, usually that will be risk-free. The idea of why it's risk-free is because they can just print more money and pay it back. So there's no risk associated with purchasing a bond that has been issued by the Australian government. If we look at beta, for example, with the beta, do you guys remember how you estimate that back in your finance class, if you've done it? Anybody? Kim? Huh? Too long ago. Do you remember? Huh? Do you remember maybe doing a regression? Did you do a regression maybe? No? Maybe not? Yeah, so basically, well, some time ago, basically you're doing a regression where you're comparing the returns of the stock with that of the market. So it's trying to measure relative risk. But how you do it in practice, it's very much up for debate because there's so many choices that you can make. Has anybody done the homework already? And there is homework for this week, just to remind you. Yeah. In the homework, I kind of go through a function here on Bloomberg, which is the beta function. So for example, if I go into the beta function, I can estimate the beta for, in this case, it's Time Warner. So the default settings would tell me that the raw beta, which is the beta for Time Warner, would be 0.699. But this 0.699, again, what it's just trying to do here is it looking at the observations of the Time Warner's return here, and then the index return, and then basically plotting them and estimating a line of best fit. And the slope of that line is essentially the relative risk of Time Warner. Again, it seems pretty straightforward, but there's so many different things that you kind of have to consider here. Because, for example, we might say, okay, so we're going to look at how are they doing it. So they're using the S&P 500 as a relative index, nothing wrong with that. They're using a 2-year time period. They're using weekly returns. So again, all of these are technically options. So for example, if I switch to daily returns, it changes to 0.622. If I go with a 5-year period, it changes to 0.748. So no matter kind of which choice you make, it will impact the estimation of the beta. And the beta, which you'll see later on, it's like one of the most integral parts of the calculation. So if we don't know exactly how we're supposed to estimate it, then how can we be certain of the result?
So we're gonna actually have to calculate it real quick.
You can use Bloomberg, but you need to understand what it actually means. Sweet. Sweet and sweet, I wouldn't call it necessarily sweet because you need to understand what it is in terms of what is a regression and what are the different parameters. Even if we look at the equity risk premium, do you guys remember what that is from the finance class perhaps? Ooh. I'm looking at the finance majors. Makes that.
Isn't like the risk that you like the risk rate, that's the risk rate. Like the rate of risk that you're gonna take. No.
Almost. I appreciate the effort. Okay, cool. So the equity risk premium is the premium an investor would expect for investing in the kind of an average risk equity investment. So essentially, it's the additional premium you would get for in addition to the risk-free rate. So the risk-free rate is completely riskless. By investing in equity into companies, you're taking on more risk. So for the average type of security, you would expect this premium. So essentially, it's usually about 5 to 6% and so forth. So again, there's different things that we need to figure out in this equation. So the first one is really the risk-free rate. So the risk-free rate, again, it might seem financy in the sense that why do we need to do this? But again, in the notes of accounting statements, a lot of the assets are valued. One of the key parts in the valuation is the discount rate. If you can't be certain that they've used the most appropriate kind of inputs into their little equations, then the result will be shit. So essentially you need to make sure that they've done it correctly. And most times people have done it really poorly. So again, for example, for the risk-free rate, effectively what we're trying to figure out is a risk-free asset and the return that we would be able to get from a risk-free asset. And a risk-free asset is essentially an asset where the return has no variance. So we know exactly what we're going to get. So if we invest in this asset, we know we're going to get 3 or 4%. So there's no risks associated with it. So the risks are technically default risks. So again, a government bond should not have a default risk if it's a stable government. There are countries that are still developing that might actually default on their government bonds. So they technically aren't completely risk-free, but if you're in a developed nation, there's generally no default risk. There should also be no uncertainty about reinvestment rates. And what that essentially means is that if you have a, let's say you're trying to estimate a discount rate for a 5-year project that your company wants to undertake, make sure that you use a risk-free rate that is for a 5-year period. Because effectively, if you use a 1-year period, then you always will have reinvestment risk in the sense that after 1 year, you need to figure out what is the current risk-free rate, and it might be different from the previous one. So essentially, you want to match up the maturities. So if we're going to be valuing a firm for an eternity, we want to use a long-term government bond. So again, risk-free rates in practice, usually what we would look at is a government bond and essentially a zero coupon default-free bond matching the time horizons of the cash flow being analyzed. Technically what this means is that if you're thinking about like a discounted cash flow model which has multiple periods, so 1, 2, 3, 4, 5, 6, in theory you should be using a 1-year government bond for the first one, 2-year, 3-year, 4-year, 5-year. In practice, nobody does this. Instead, what people do in practice is they tend to use a 10-year government bond. That's just like a shortcut people do. It's not necessarily the most appropriate thing to do, but it's still a shortcut. Again, generally speaking, what you need to figure out is, for example, if I'm valuing H&M, I need to figure out what is the government bond in Sweden currently paying. So on Bloomberg, you kind of need to either know the government bond security code, or you can just type in like Sweden government bond, and let's see, and technically I know it's this one, so Swedish government bond 10-year note. So you're basically trying to find the current 10-year bond. And again, you get a bunch of different options here. If I go to the line chart, I'll see kind of how it's developed over time, and I'll see, again, it's kind of volatile, but essentially I can see an overview. And again, this is for the past year. If I go for the past 5 years, I can see that it used to be about 2.5%. It kind of went down quite drastically to almost 0. And it kind of gone up and so forth. So you want to figure out what is the current basically government bond rate. Again, this is just a line chart. If you click on the table there, you can actually see an overview of the actual prices. So that's kind of this would be, for example, if we want to figure out what the current rate is, well, it's 0.829%. So it's less than 1%. So it's still very, very low, but this is essentially what we would use. The only other issue here is really that when we have times of abnormally low interest rates, you might not actually use this amount. You might actually look at what is a normalized risk-free rate. So a normalized risk-free rate is the idea that over time there'll be kind of fluctuations. So if I go back to the chart, so over time there'll be fluctuations in the risk-free rate. And again, this is the Swedish government bond back from 91. So in 91 it was like 12%, even more than 12%, and over time it's gone down and so on. If you were to do this even in a longer period, you'd still have huge amounts of variation. So what this tells me is that this seems to be really abnormally low. So I can't really use this amount if I'm going to be doing a long-term valuation. So if I'm valuing a firm on a long-term basis, I don't want to use a rate that is abnormally low or abnormally high. And again, people still sometimes actually use these rates, but then the valuation kind of falls apart because it's based on an unrealistic risk-free rate. So what you could do instead is to use what they call a normalized risk-free rate. So a normalized risk-free rate basically is estimated by looking at the long-term period and figuring out what is the kind of average risk-free rate been for the past 50, 60 years, or however long you could basically figure it out. Again, you could do this exercise yourself by getting the numbers from Bloomberg or somewhere else, or again, Google is your best friend, or I guess I'm using Edge here with Bing. So normalized risk-free rate. And basically what you're figuring out here is kind of what people think the normalized risk-free rate is. So for example, here in Duff & Phelps, so in the US, basically the biggest authority on risk-free rates, market premiums and everything is Duff & Phelps. So Duff & Phelps generally issues what they believe are current normalized risk-free rates. So if I click here, I can see that, for example, let's see what they've said while it loads. So basically, Duff & Phelps in this case has issued an executive summary here that they've decreased the normalized risk-free rate from 4% to 3.5% effective November 15, 2016. So again, in real life, what you would do is you usually use this number because, again, Duff & Phelps says so. And again, what Duff & Phelps would have done is they would have gone back for the past 50 or 100 years, or however long they could find the data for, and figure out what is the average risk-free rate. And the idea here is, again, by doing so, you can figure out what is a normal rate for the risk-free rate. Because again, if you're using an abnormally low or high rate, it's gonna impact your end result. So in the homework, for example, and again, this is kind of what the homework looks like for this week. Don't worry that you haven't done it. Here at the very end, what I did is I did it like a WACC sensitivity. So these numbers are the weighted average cost of capital numbers, and this is like a sensitivity table that if the risk-free rate was 4.88% and the beta was 0.6, this is what the WACC would be. If it instead was 0.88%, which is kind of what it is right now, and the beta was 0.6, this is what it would be. So what you can see here is that the risk-free rate has quite a big impact on the weighted average cost of capital. And again, technically, this is the current rate. The normalized risk-free rate for Sweden might be around 3-4%. So all of these are technically somewhat acceptable to use in a valuation. But depending on which one you choose, your WACC is going to be very, very different. And once you start plugging this WACC into like a discounted cash flow model, it's going to change the valuation, and sometimes it will double. Because again, we have 4%, we have 8%. If we choose a 4% discount rate, we're essentially saying that the company is less risky. So the discounted cash flows will essentially be much higher. So again, depending on what you do, you will have an impact on the end value there. So again, when we're looking at risk-free rates in practice, again, we tend to use a long-term government bond. So a 10-year note is generally what you want to do. If you're doing it from a developed country perspective, you don't necessarily have to do anything beyond the fact that you need to observe what the current rate is. If you're valuing a firm that is in an emerging market, you need to kind of account for the fact that their risk-free rate or their government bond would actually not be completely risk-free. So for example, if we're looking at a government bond in, let's say, India, so back in 2013, the Indian government Rupee bond rate was 8.82%. But the problem is with the most developing countries, there will be a default risk. So this 8.82% is actually not the risk-free rate in India. Because this is still a risky investment because I know the Indian government can default on that bond. So what it can then do is to figure out what do the credit rating agencies rate India as. So the local currency rating from Moody's was Baa3, so the default spread for a Baa rated country bond was 2.25%. So basically, this is the premium I get for investing in a risky government bond, specifically in a Baa3 rated bond. So if I wanted to figure out what is the true risk-free rate in India, I would maybe subtract this from the observed rate to get what is the risk-free rate in rupees. Similarly, again, the next line is essentially doing the same thing for the Chinese bond. But the idea here is that if you're valuing a firm in a developing nation, you can't just use the government bond rate because it's going to have in risk kind of embedded within it. So again, that's kind of the risk-free rate. Again, few different options. The biggest issue here is really, do you use the observed rate or do I use the normalized rate? That's kind of the big option for your project. The second part of the equation is the equity risk premium. And again, I've already kind of went through this, but basically an equity risk premium is the premium that investors demand for investing in an average risk equity investment. So the idea here is that the premium that they get in addition to the risk-free rate. So how much in addition to the risk-free rate do I get for investing in stocks in general? Again, a few different approaches of how you would actually estimate it. So you could, for example, ask your boss, because generally speaking, most firms will have a standard equity risk premium that they use for a certain country. So in Australia, KPMG might use 6%. For any US valuation, they might use 5% and so on. Generally speaking, what they would have done is they would have actually used the last approach to figure out what they should use. So for example, you could do that the actual premium that we're trying to, I guess, estimate is going to be the premium of the average stock return compared to the risk-free rate over a longer period of time. So imagine if you go back 50 years and you plot the returns of the market versus that of the risk-free rate. So the difference is essentially the premium. And if you figure out what the premium is over a long period of time, you effectively can figure out what is the equity premium. So the idea is that people tend to do this. And again, Duff and Phelps does this for you, so you can actually figure out what is the equity risk premium in the US, Australia, wherever, and you'll get really good results there. But the idea here is that technically it does say that the equity risk premium is the premium that investors demand for investing in the average equity investment. So technically you could also just survey investors and ask what they demand, because that's actually what the definition is. So again, a few different approaches. If we're going to look at surveying investors, we have a bunch of different people that have done that before over a long period of time, and generally you get quite a big spread depending on if you use retail investors, institutional investors, but it tends to be around 4, 5, 6, 7, 8%, so it's somewhere around there. The idea here is essentially that you can effectively just ask people what they demand for investing in equity securities to figure out what the equity risk premium should be. But again, the most common approach is to just look at historical returns of the market compared to the historical returns of the risk-free rate and look at the difference over a long period of time. Because the difference implies what the additional premium is over a longer period. So again, the historical premium approach is the most common one. Again, it's the most common, but it's still somewhat controversial in the sense that there are a bunch of different choices that you have to make. The most important choice is really the time period for the estimation. So if we're going to look at the returns of the market versus the return of the firm, so let's see, if I go to Bloomberg and I type in equity risk premium, there's a function called EQRP, and again, if you just type in the word equity risk premium, you'll find it. It kind of graphs, okay, so I have, let's see, I'll go to Time Warner Inc. So basically what it's done is it's kind of looked at the equity risk premium for Time Warner by plotting the returns of the market versus that of a risk-free rate. And the idea here is that really what you need to figure out is how long of a time period do you go back. So if you want to do a historical premium approach, the biggest issue is really how far do you go back. Do you go back 50 years versus to this beginning of time? So what is the pros and cons here? So what is the pro of going back 50 years versus going back to 1928? More data. So if you go back, okay, so if you go back to 1928, you get more data. Any issue with 1928-ish? Different. What else happened back then? Great Depression. Sweet. Okay, so there's some weird stuff happening. Is it good to include weird stuff or bad to include weird stuff?
Depends.
Awesome answer. Why does it depend, Nick?
Well, it depends. Like, I mean, it could be relevant to include like that far back if you're doing like indefinite, like a infinite.
Yeah, so basically forever. So
Because like that could happen again.
yes, that could happen again. So some people would argue that no, it's not good to include a weird period because it's not representative of the future. Yeah, but on the other hand, what Nick said is that technically it can still happen in the future. So just because it's weird blip does not mean that that blip can't happen in the future. So going back and including the Depression is actually not a bad thing to do because it's still part of history and it will still tell you what the historical returns have been. But some people might say, well, technically the equity risk premium changes over time because what people demand for investing in equities has changed over time because previously investing in equities was much more risky. So the premium was much higher in the past and now it's kind of shrunk over time. But again, essentially that you have many different choices here and primarily around the time period. So again, what you essentially do is you calculate the average return for the stock index for the period, calculate the average return for the riskless securities, so the kind of the government bond for the period, and then look at the differences between these two averages. Again, really what the limitation of this approach is really that it assumes that risk aversion of investors has not changed. And as I mentioned, generally speaking, people actually demand slightly less of a premium for investing in equities these days than they did in the past. So again, historical premium approach is the most common one, but even this still has some issues with it. Now, we come to the beta. So the beta is really the biggest issue when it comes to any discount rate. The beta is really the most problematic number because it has so many variables that need to be kind of decided on. So as I mentioned, the standard way for estimating betas and the way you might have been taught in the fundamentals of finance or finance classes is that you're essentially regressing the stock returns against the market returns, and you're effectively trying to estimate this little equation where RJ is the return of the firm, alpha is the intercept, beta is the slope, and RM is the return of the market. So by figuring out the relationship between your firm and the market, you estimate beta, which is essentially the relative risk. So if your beta is greater than 1, you generally are more risky than the market, if you want to think it that way. Again, the idea here is that you're trying to understand what is the relative risk of my company. Again, when we're looking at betas, there are a huge number of decisions, and I've kind of shown you the little Bloomberg tab. But basically, you have similar issues when you look at the historical risk premium because you need to figure out what is the estimation period. So do I go back 100 years? Do I go back 5 years? Do I go back 2 years? And so forth. Again, the idea is the same in the sense that if we go back a long period of time, we get more data. But if we go back a long period of time, we might get irrelevant data in the sense that they might be not representative of the risk of the firm. So generally speaking, in real life, you would use a 2 or a 5 year period. So if you have a stable company, you might go back 5 years. If you have a company that's growing and becoming, I guess, changing its product mix or whatever, then you might only go back 2 years. You then need to also figure out what is the return interval that you're using. Are you using daily observation, weekly observation, or monthly observations? Again, kind of depends on your point here. So what's the problem with using daily observations for a small company? Not much happens, sweet. Okay, basically, so if you have a small company, sometimes they're not traded very frequently. If you have infrequent trading, you sometimes have companies that have 0, 0, 0 returns while the market moves. So if you were to estimate a daily return observations against that in the market, it might actually deflate the beta in the sense that it will look a lot less risky, because while the market is going up and down, your return is 0, 0, 0. So your return to that of the market looks to be very much kind of out of sync. So you're going to look at the relative risk is much lower. So the idea here is that generally daily is almost never used. So instead people tend to use weekly or monthly. The second shortcut people would say is that when you use a regression beta, you should have 60 observations. So that's a general guideline, which means that if you want to use monthly returns, to get 60 observations, you need to go back 5 years. If you use weekly, well, then you can go back 2 years or 5 years. But again, because you need 60 observations, if you want to use monthly returns, you need to go back 5 years. And then finally, what you need to do is choose a market index and estimate the returns on the index. So the idea here is, again, we're trying to estimate relative risk. So if I go back to Bloomberg and I go to the beta page, actually, we might have a, do you guys want a break? Yes or no? Yes. Sweet. Is this, I thought you covered this in finance. I would have thought you guys, oh, I know this, Tim, I know this. 2015? Okay. No worries, just chill. Okay, so come back in 10 minutes and we'll continue that. Okay, so we kind of stop with the beta. So beta is basically what we're going to be looking at. So before we went on the break, I mentioned that when we want to estimate a regression beta, bunch of different choices here. And all of those choices have to be made. And the last one we talked about is the market index. So why do we need to choose a market index? So, okay, so what are we doing when we're estimating the beta? What are we doing? Is it Josh? What are we doing? Regression. So what do we need? We need two things. We need the stock return and that a return of something else. The market. What is the market? It's a good question. Yeah, so basically this is like a really fundamental question, but nobody has a good answer. So historically speaking, if you wanted to estimate the beta, for example, if you say H&M, if I go to H&M, SS equity, Bloomberg does this by default. It selects OMX, which is effectively the Swedish stock index. So the problem here is essentially, well, what are we doing? So we're estimating relative risk of H&M to that of the Swedish stock market. Do investors care about this? No. Okay, good. So that's your laughing. That's good. Basically, the idea here is that if you're estimating relative risk, you should be doing it relative to something that matters. So again, back in the day when everybody who invested in H&M were Swedish and all their other options were Swedish stocks, this would make sense. These days, this makes zero sense, but people still do it. And again, if you go through all of your notes in your financial statements and how they estimate beta, if they actually disclose it, they would have used a local index, which makes no sense whatsoever. So what you could do instead is to use a, let's say, a worldwide index. Because again, if this is a large firm, it means that the investors generally will be ones that are investing within the whole world. So for this purposes, you could use, for example, the MSCI World Index. So I might just change the relative index to the MSCI World Index. And whenever I make a change, I need to press enter. So again, the raw beta right now is 0.722. If I press, oopsie, made a mistake. If I choose the MSCI World Index, we can just see how much it changes. 0.722 to 0.514. So it's still a big change there. And again, that's just the relative index. You can still play around with the daily, weekly, monthly, the time intervals. So basically, no matter what choice you make, the beta will change. Then we have another issue here. So let's see how much you remember. When was the last time you took statistics? 2-3 years ago, that's fine. Do you guys remember anything about like standard errors? Ooh. Okay, what does this name imply? Standard error.
Sorry.
What does standard error imply?
It's the.
Standard error?
It's
In an exam situation, might even give you a pass. Okay.
Is it not the amount that, like, the average would
Kind of variation of the
from the regression line?
Yeah, because if you look at this point, like this raw beta, that's the beta that you would use in evaluation, 0.514. That's a point estimate. That's your best guess. So it's just your best guess, but it's still a guess based on statistics. What that needs to be considered in relation to is the standard error. Again, the standard error is kind of tells you how good of a guess is that raw beta. So that raw beta is your best guess, but what is the confidence you have in that estimate? So the lower the standard error is, the more confident you are in that estimate. The general rule of thumb is, let's say, I'm gonna make this a bit simple, but let's say we wanted to be 95% confident about beta. If you want to be 95% confident about beta, you would take the point estimate, you then take the standard error, multiply it by 2, and subtract an add. So in this case, 0.25 multiplied by 2 is 0.5. So 0.5 minus the raw beta and then plus the raw beta. That gives you the low bound and the upper bound. So you're 95% confident the beta is between 0 and 1. That's not really that assuring. But that's effectively what we're doing here. So again, whenever we see a beta, whenever I see a beta used in practice, I know it's somewhat up to interpretation because again, I know it's never going to be that certain. And we always need to consider it in relation to the standard error. So whenever you see a huge standard error, generally means that raw beta estimate is not necessarily super precise.
What's a huge standard error?
A huge standard error is basically anything that will, if you always need to consider the standard error in relation to the raw beta. So if the standard error is 0.25 and like if the raw beta is 1, then this would be 0.5 to 1.5. To me, that's slightly better than 0 to 1. But there's no real general guideline. But whenever I see beta have a bigger range than, let's say, 0.2, 0.3 to either side, that's a problem for me when it comes to, I guess, the 95% confidence interval. So again, if you go back to your stats class, you know that 68% of the time it falls within one standard error. So if you just wanted to be 68% sure that beta is one number, then you would take one standard error minus and then plus it. But would still be basically that you're 68% sure that H&M's beta is between 0.25 to 0.75 still doesn't give me a lot of assurance here. So again, beta in general is a horrible number, but it's basically the best thing that we have. So there's really no other good alternative. So people do this even though it's horrible. So if we want to look at standard errors in practice, so this is like an overview of a standard errors for US stocks. So basically, if we estimated betas for all US stocks, this will be the distribution of standard errors. So the most common standard error is about 0.2 to 0.3. So the H&M standard error was 0.25. Basically, it's the most average type of firm. So it's not abnormally large, but it still makes it huge in the sense that the end result is that to be 95% sure, it's going to be between 0 and 1, which is like, does it kind of worthless. But again, you do have some stocks which have like standard errors of 0.4 to 0.5 and so on. Basically, what this highlights is that beta is a horrible number, and you really should never use beta in a way that you're certain about it. You should always be somewhat uncertain about what it is, which means that whenever you do evaluation, you should always do some form of sensitivity around the beta. So this is like the H&M beta for the homework. So I can go below 0.2 and then above 0.2. So if my estimate is 0.8 for the beta, I want to see kind of what is the impact on the end result here if I go take minus 0.2 and then add 0.2. So 0.6, 0.7, 0.8, 0.9, and 1. Again, your range could be even larger. But the idea here is that you basically test the sensitivity of your assumption, because you know that your assumption, no matter what you do, is going to be shit when it comes to beta. Because beta is a horrible estimate, but it's integral to everything in finance and accounting, because all discount rates would use this. And again, you can't trust it, but it's the best thing you have. Alternatively, what you could do is to just look at it from a qualitative point of view. So a qualitative point of view, which sounds really fluffy, just means, well, let's be reasonable, logical, and try to figure out what beta is actually capturing and determine whether the estimate that we have is reasonable. So what beta is trying to capture is relative risk. That's all it's trying to do. So the regression approach, that's one approach, and that's probably the most common one. But you can also do it as a thinking exercise in a sense. I want to understand what the relative risk of the company is, so I'm going to look at its fundamentals. So I'm going to look at what is it selling, what is its operating leverage, which is basically the fixed cost versus variable cost, and what is its financial leverage. And based on those things, I should know whether it's risky or less risky. And even if you go back to your risk analysis week, if you know it's a very risky situation, you already know that the beta should maybe be higher and so on. So for example, product type. So product type basically just means that your beta is completely dependent on what you sell. So if you sell something that people don't need, they just want it, you're going to be more risky. So again, if your demand for your products is cyclical or it's discretionary, you're more risky. So again, if you go back and compare an organic food store to Aldi, the organic food store is more discretionary. People want organic food, people don't need organic food. Cyclical companies as well. If your company follows the economy and there's gonna an economy downturn, you're gonna be more risky. Usually these two things are combined in the sense that if the economy goes down, discretionary product demand goes down as well. Because again, people need food, but they don't need organic food, so they switch their food purchases to Aldi or somewhere cheap. But the idea is that the prototype will tell me what the kind of risk of the company should be just by looking at what they sell. So if you sell something that people just like to have but they don't need, you're going to be more risky. You could even use this approach to figure out the beta for a company that's not listed. So say, for example, you need to figure out the beta for a company that's unlisted, or for something that is effectively where you don't have an observable comparison. What you can do instead is, again, go through this exercise to figure out what do we sell, who needs it, and what is basically the relative risk and so on. Again, the second aspect is operating leverage, and I think I mentioned in other classes as well. So operating leverage is, again, the idea of your proportion of your variable and your fixed cost. So essentially, what is your fixed cost in comparison to your variable cost? And the idea is the more fixed cost you have, the more risky you will be. The idea here is that if the economy goes down or if sales go down, if you have a lot of fixed costs, your costs stay the same, which means that it hits your profit quite dramatically. If you just have variable costs and sales drop by 10%, well, then your costs drop proportionally. So it's not going to be as big of an impact. So the idea here is the more fixed costs you have, the more risky you'll be. Again, usually this is not observable for most firms, because if you're an external party and investor, you can't observe this. Instead, what you can do is you can look at the EBIT variability measure. So basically what you do is you look at the change in EBIT and divide it by the change in revenues. The idea here is, again, if revenues go up, down, you want to see what relationship does the change in EBIT have. The idea is, again, if it's more variable, then that implies something about the operating leverage. And then finally, we have financial leverage. And financial leverage is somewhat easy to understand, but the idea here is that whenever you borrow money from a bank, you're effectively taking on more risk. Because again, one is that you have more financial debt, but really what we're kind of concerned about is really that as firm borrows, they create fixed costs. So interest payments are fixed costs. If the economy goes down, you still have to pay the bank, which kind of increases the risk. So whenever we see a beta in the market, so say for example, we look at the beta of H&M here, this 0.514 already accounts for the risk of their operating leverage, it accounts for the product type, and it accounts for the financial leverage. So if we want to compare the betas of two different firms, just because they're in exactly the same industry does not mean that the beta will be the same, because their product type might be slightly different, even though it shouldn't be. But what will be different is their operating leverage and their financial leverage. So what you can do, what people sometimes do, is they try to unlever the beta. So again, if we know that the observed beta from the regression is one that is levered, in the sense that it basically accounts for the financial structure of the firm, what you can do is you can say that I can try to unlever it, because this will tell me what the business, what the relative risk of the actual business is without any form of debt. So the idea is that you get a more close idea of what the true relative risk of being in this industry is. So you essentially just plug and play this formula, and essentially you plug in the formula to figure out what the unlevered beta would be. But again, the idea here is that you kind of go through the different aspects of the firm to figure out what is an appropriate beta, given that the fact that it might be selling a discretionary product, that it has high fixed costs, and it has high financial leverage, because all of those are indicators. And again, you could use this, again, as I mentioned, this exact exercise to figure out what the beta should be for a firm that might sell something that is new, or they might just not be listed. So say, for example, you have a firm that wants to set up a new division, and that something is completely unheard of in the market. So for example, I think Tesla, I'm not sure if they're still looking into, I guess they're trying to build their solar or whatever plant. I think you guys are using that case in corporate finance, no? Or yeah, I mean, somebody else done it. Yeah, so basically the idea here is that you have a new business line where you can't necessarily understand what the beta should be, because again, what is the relative risk of this project? Because it's something that is not existent. So I think they're building is it the solar plant or is it the battery plant?
Something to do with the battery.
Yes, I think they're trying to basically create a new battery manufacturer facility. So what is the relative risk of this project? So again, in this case, really difficult to do this, but you can again look at what am I selling, what is my operating, what is my financial leverage. In the case of like Tesla, the easiest thing to figure out is just what is the relative risk of their customer. Because really, your relative risk is directly linked to the relative risk of your customer. If your customer is one single firm, then your relative risk will be exactly the same as their risk, because if they go away and they experience a downturn in the economy and they kind of are hit, you will be impacted. Again, because beta is a horrible measure, there are a few other approaches. So one is, again, the qualitative approach, just figure out what is the firm doing. What you can do as well is a comparable firm beta. The idea here is that one firm's beta is horrible, but if you take multiple firms and take the average of that, it will be slightly less horrible. So essentially you have the law of large numbers, in the sense that the bigger the sample you have, the lower the error will be. So what you would do in this case is you would look at a few comparable firms. So in the case of H&M, you might look at Zara, Uniqlo, Gap, and so on. And you can try to observe their betas in the market. So you effectively estimate the regression beta for each and every firm. Once you've done that, you also need to account for their capital structure, in the sense that we know that financial leverage increases the observed beta, because the more leverage you have, the more risky you are. But in order for us to understand what the comparable firm beta is that is associated with being in the kind of clothing retail industry, we need to adjust this for the financial structure. So essentially we're going to use the formula on the previous slides to account for their debt to equity percentage. So for example, for Gap, their regression beta is 1.08, but this one is biased upwards because they hold financial leverage, because they have some financial debt. So if you unlever this beta, you see that it's only 0.98 without any form of debt. So the more debt you attract, the more debt you take on, the higher your observed beta or your regression beta will be. So again, what we do is we unlever all of these betas for all these 5 firms, taking into account the capital structure and the tax rate of the countries, figuring out what the unlevered betas are, look at the average, and that gives us the average beta of the clothing retail industries for comparable firms. And then in H&M's case, what you would then do is you look at the capital structure of H&M. H&M basically has 0 debt, more or less, which means that the 0.94 will be exactly what the relever beta is. If H&M had a huge amount of debt, you then relever this beta based on the formula, and this will be higher. So the idea is that you're looking at comparable firms, how risky are they, figuring out what is the average riskiness of these firms, and they're adjusting for your own capital structure. So this is one approach, very common in Europe. The next approach is called a bottom-up beta approach. It's basically doing this, but on a much, much larger scale. So a bottom-up beta approach is particularly super useful if you're dealing with a firm that is operating in multiple segments. So let's see, we have, who is doing what? Mantra, Buffalo Wild Wings, Westfields. You guys are doing Time Warner. Yes, Time Warner, for example, is actually a good example here. If we have a company like Time Warner, how many segments do they operate in? I'm not sure if they still have the funeral homes, but back in the day, Time Warner used to have parking lots, funeral homes, cable network, movie production, all these various things. So when you start to think about product type and all these issues, it becomes really hard for a firm that has multiple different segments, like what is the relative risk of each segment. So what you can do for these firms is to do a bottom-up beta. So bottom-up beta, again, it's similar to the comparable firm approach, except it breaks it down into industry segments. And effectively, what you're trying to do is estimate comparable firm betas for each industry. So again, this very much a dumbed down approach of the bottom-up beta, which does this for each industry that you might be in, but even does this on a much, much more specific scale. So the idea here is essentially that we might have firms that are operating multiple industries. So it might be better to break it down into parts. Specifically, this is really useful if you know that you are operating in multiple industries, and going forward, this product mix might change. So your regression beta will be based on your previous product mix. The bottom-up beta can be based on your kind of future product mix. Again, how would you do this? For example, in this case, we have Disney as an example. So Disney is technically operating in 5 different segments. They're somewhat related, but they're effectively something within entertainment. So they have media networks, so their Disney Channel, they have their parks, they have their studio entertainment that produces the content, they have products, so their merchandise, they have interactive, which I think does gaming or even animations. But effectively, they have 5 different segments that technically have different risks associated with them. So for Disney, what you might do is, again, you would identify the segments that they operate in. Usually you do this by going through the footnotes. In the footnotes in the annual report of 2013, you'd figure out that what the revenues, what the operating income, what are some of the key financials with each part of the business. And you'll use these later on to figure out what is the weight of each part. Because technically speaking, just because we know the relative risk of each particular part, how do we then combine it? How do we weight? Do we weight based on revenues? In which case, we can see that media networks is about, let's say, 20,000. We can see that studio entertainment is about like a third of media networks. But if we look based on profits, we can see that studio entertainment is a 10th instead of a third. So what you weight on is also important here. So you kind of need to figure out what are some of the key financials. What you would do is essentially try to figure out what is a comparable firm beta for each business type. So for example, for studio entertainment, you might find US movie firms, you might find 10 US movie firms. You then look at what is the median beta within this sample of 10 firms. So it might be 1.24. So essentially you'd go through the regression betas, figure out what they are for each and every firm, and you might find that 1.24 is the median beta. You then figure out what is the median capital structure, what is the tax rate, to then unlever it, and it's 1.0668. Technically speaking, we also have the issue of cash, which we haven't covered so far. Why would cash impact beta? Is cash risky or less risky? Less risky. So if you have a lot of cash, should your beta be higher or lower? Lower. Yeah, so the idea is that by holding cash, you're basically artificially manipulating beta. So the idea is that if you have a lot of cash, your observable beta will be lower than it actually should be. So for example, if we look at the interactive industry where the, I guess, median cash to firm value is 17%, so they hold a lot of cash, just because their unlevered beta is 1.0, more or less, because they hold a lot of cash, this has actually been biased downwards. So we can essentially do a last step, which is the business unlevered beta, which is basically just adjusting for cash. Again, how would you do this, for example, for student entertainment? Again, you figure out what is the median regression beta, and you would do that, I think, on the next slide. It actually shows you. So here are comparable firms. These are the levered betas that we observe in the market, so this column. What is the median beta? 1.24. Same you would do with the capital structure or the marginal tax rate. So if I look at the debt to equity ratio in this column, the median is 27.04. So the idea here is that you're trying to figure out what is a comparable firm look like in this particular industry. So based on these inputs, again, we start with the median regression beta, 1.24. We unlever it. Using the formula here, we get the unlevered company beta. We then might adjust it for cash by using this formula below. So the idea here is that it's a step-by-step approach, but again, it takes a whole lot more time. But again, it's quite useful if you have a company that's operating in multiple segments. So again, essentially kind of just goes through this process, and this is the table that you'd use to figure out what are the inputs. Essentially, you have the median beta, the cash to firm value, the debt to equity ratio. So you have all the inputs into the formula here. Again, once you figure out what is the unlevered beta associated with each industry, you then need to figure out how you weight it. How you weight is completely dependent upon what information you can get from the company. Because some companies won't necessarily disclose profit values for each particular segment. They might only give you revenues, for example. If they only gave you revenues, you could look at what on average is within the industry is the, I guess, for example, the enterprise value in relation to people's revenues. So here, for example, we see that enterprise values for each firm are. We can also see that if we take their revenues and essentially compare them to the enterprise values, we can essentially see what the median enterprise value to sales ratio is, which is 3.05, which is the number here. Multiply the revenues by this number and you get the value of the business that's implied based on comparable firms. And you can then use this amounts, so the value of the business, as the weightings for these betas. Again, really long approach. It mainly makes sense if you have a company that has multiple segments, and particularly if you're changing product mixes going forward. So if you have a company that just divested from one part of its business, it's no longer going to be there going forward. This is what you would generally use. If you only have one industry for your company, this makes very little sense to use. In which case, this one, much more simple, much more straightforward, would be a lot easier to use. So again, for your project, what I would say is that you need to do this. You also need to do regression betas for your own company to figure out, okay, so if I use a regression beta, what is it? If I use a comparable firm beta, what is it? Because this will tell you some points of information of what could the range of beta be. You then also need to consider that when you do a regression beta and figure out what it is, see how sensitive it is to some of the assumptions around time period. Do I use daily, weekly, or monthly time intervals? Because again, these will give you some points of evidence that if you do this and this, it's 0.5. If you do that and that's 0.9. So I know maybe something between there. And you can also consider standard errors. But the idea is essentially you're trying to understand what is a range that is appropriate for the beta estimate. Because again, no matter what you do, the valuation will be very, very sensitive to the beta assumption. So again, the beta going again from 0.6 to 1 has an impact on the weighted average cost of capital. And once we start using it next week for some of our evaluations, it might actually increase the valuation by 50% or 100% depending on your circumstances. Are there any questions? Is this easy, not easy? Basically, there's a whole bunch of options. If you get confused about this week, go back to this slide, and these are the things that you need to know. Basically, the inputs and how do I get these inputs. Basically, this whole session was how do I figure out that, how do I figure out that, how do I figure out that, and so on. Tax rate we haven't covered, but tax rate, if you remember from the week when we covered the forecasting and we looked at the KPMG tax rate table, this is how you would do it here as well. But again, for this week, what you effectively need to do for your project is to determine each and every input, because by determining the inputs, you then get a final whack. All right? Cool. If you have no questions, you're free to leave, or if you want, you can start on your projects and continue, or again, I'm pretty sure you have midterms, so I'm completely fine if you go and study. Your midterms, I'm hoping, will be done on Thursday, so I would probably expect it on that date. Cool? Done. Yeah. Oh, sorry, I'll come. Yeah.